remains strong. I would now like to focus on the decisions and deliberations of the Monetary Policy Committee. Against this background, the Monetary Policy Committee, that is MPC, met on 3rd to 5th August and reviewed the macroeconomic situation and its outlook. The MPC decided unanimously to increase the policy repo rate by 50 basis points, 50 basis points to 5.4% with immediate effect. Consequently, the standing deposit facility, that is SDF rate, stands adjusted to 5.15%, and the marginal standing facility, that is MSF rate, and the bank rate stand revised to 5.65%. The MPC also decided to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going while supporting growth. Let me now dwell briefly on the MPC's rationale for its decision on the policy rate and the stance. Against the prevailing adverse global environment, the MPC noted that domestic economic activity is resilient and progressing broadly along the lines of the June resolution of the MPC. Consumer price inflation has eased from its surge in April, but remains uncomfortably high and above the upper threshold of the target, that is 6%. Inflationary pressures are broad-based and core inflation remains at elevated levels. The volatility in global financial markets is impinging upon domestic financial markets, including the currency market, thereby leading to imported inflation. While inflation, or rather let me put it this way, with inflation expected to remain above the upper tolerance threshold in Q2 and Q3 of the current financial year, the MPC stressed that sustained high inflation could destabilize inflation expectations and harm growth in the medium term. The MPC therefore judged that further calibrated withdrawal of monetary policy accommodation is warranted to keep inflation expectations anchored and contain the second round effects. Accordingly, the